I think this is where we stopped. I think we were looking at a couple of models which we can measure the impact of interest rate changes on either on your income or on your equity. So basically, the two models we discussed were uh, repricing gap model and the what you call maturity gap model. So in the repricing gap model, it's a static model where we basically look at interest rate sensitive assets and interest rate sensitive liabilities mismatch during a particular time horizon, 3 months, 6 months, 1 year, and so on, and see what could be the impact it any interest rate movement has on our net interest income. So the formula is net interest income equal repricing gap times the change in interest rate. So depending on the gap and the depending nature of the gap, whether it's positive or negative, and also depending on the movement of interest rate, we know what would be the impact. So I think we discussed in detail and we looked at few examples as well. So if the C gap is positive when interest rate increases, what would be the impact? When the C gap is positive, interest rate decrease, what would be the impact? When the C gap is negative and interest rate increase, what would be the impact? And C gap is negative, interest rate decline, what would be the impact? And also importance of C gap ratio as a measure of risk indicator in many banks and financial institutions. Once you set up a particular C gap for a particular period as a risk indicator, so you can always look at the actual or the forecasted C gap with a targeted C gap, which is the risk indicator, and whether you are subject to a potential risk of interest income, okay, negative interest income, net interest income. So that is important part. Then also we looked at the how we can restructure the model, the formula for when the both now earlier the simple model is that both rate sensitive assets and rate sensitive liabilities changes in similar amounts. But if they don't, we can't use the formula, but we used another formula when the changes are different. So this is the formula on the very bottom, RSA times delta R RSA minus RSL times delta R RSL. So that we can again measure the impact on net interest income. But the problem we saw is that it's a book value where we only consider what you call the rate sensitive assets and liabilities. We ignore in rate insensitive assets and liabilities. But again, the cash flow impacts within a maturity bracket we ignore. So those are drawbacks we looked at. Then we move on to the maturity model, which is more better model than what you call repricing gap model, in the sense that it looks at the fair value of all assets and liabilities in terms of maturities. So basically, we looked at the maturity profile of the entire balance sheet, assets and liabilities, and look at the gaps. So idea here is basically to minimize the interest rate risk in a way that maturity gap is much narrower, so that if we can maintain maturity gap much at a very comfortable low levels, either close to zero. Okay, so it's difficult in practice. You can make in a banking institution to make maturity gap to zero, but if you can make it much closer, definitely then you can use it. Okay, right? So that is the idea behind maturity gap model. So, but again, if you look at maturity gap model, two major problems were that we don't consider the degree of leverage, that is debt and equity ratio, and also in reality, what you call the maturity is not the real maturity. But if you look at asset or liability, which has in between cash flows, for example, like a deposit product, even when you pay monthly interest, the structure is different. Okay, the real maturity is different. Similarly, if you invest in a government security, treasury bond, when you receive 6 months coupons, then your real maturity is different. So, which is called the duration. Okay, so duration appears to be a somewhat better model to measure the interest rate risk over the maturity model. Okay, so that's the purpose of today's discussion. We move on to the duration model. Before that, are there any questions you need to clarify from what we discussed under the previous two models? No, no questions? Right. So let's move on to the duration gap model. So what is duration? In simple terms, duration is the weighted average time to maturity on assets or liability using the present value as weights. Okay, so we will look at in detail. Now, take a very simple example of a loan of 100,000 given at a rate of 15%. Okay, so we need to be settled on over a 1 year period, of which 50,000 to be paid on 6 months time, and the balance 50,000 to be paid after 1 year. So if you look at the first 50,000, the interest is 7,500 because 50,000 into 15% divided by 2, 57,500. And then for the balance 6 months, we have only 50,000 left. At the 15%, your interest component for 15% for 6 months would be 3,750, right? So the cash flow of this particular loan after 6 months, 57,500, and after 1 year, 53,750. Okay, so if you look at the total cash flows after 1 year period, it comes to 111,250, right? So, but if you put these cash flows on time basis, I think all of you have done present values. Now, when you want to now, how I think most of you are bankers, okay? How do you decide when you give a loan to somebody? How do you decide if it is a equal term loan? Let's say I'm talking about a term loan. How do you compute the premium? Sorry, not the premium. The principal, the installment the customer would require to pay. What is the basis? Now, when you say, okay, when I come to the bank and okay, ask you to give me a 5 year term loan, maybe paid monthly or maybe paid 6 months or whatever. So how do you compute the installment if it is equal basis, general equal basis installment? What is the methodology you adopt? Can someone tell from banks? Ola, I think all of you are giving loans, hopefully. Anyone? What is the methodology? This is your day-to-day business.
The loan amount divided by number of months, that will be the capital amount. The loan amount into the interest rate and divide by 12, or divide by 365 into 30 or 31. Total it give the installment amount.
Okay. So what is the now if you take equal installment, that is okay, what you said is right, but what is the principle you follow? Principle you follow generally?
Equated monthly installment basis.
Yeah, let me move on. Yeah, what is that? Yeah, you can. Tabodini, no?
Yeah.
Yeah,
Equated monthly installment basis.
yeah. Now, what is I am asking, I know the principle. You take basically the present value principle, isn't it? Okay.
Yeah, yes.
So basically the present value principles, how much you want to ensure, I mean, at the end, what you recover is the basic amount you give. Okay. Nothing much. So if you give 100,000, at the end of the day, you recover that 100,000 only, nothing else. Okay. But the installment is based on the time value factor of your interest rate, discounted factor, right? So it's basically the present value you use, nothing else, right? So that's the important part. So I want to highlight. So when we work out, you will see. So here, if you look at the present values, present value of the first 6 months cash flow is, in simple terms, so 57,500 divided by, if it is 15% half year interest rate would be 7.5, so 107.5 into the power 1 period. So it is 53,490. And if you look at the present value of the second cash flow, that is 53,700. If you look at half yearly interest rates, 1.075 for the 2 periods, so divided by 1.075 up to 2, to the power 2, come to 46,510. So if you add those two, basically it comes to your loan amount, 100,000, right? So basically you recover your 100,000 in terms of present value, nothing else. So if I divide the fraction of this 100,000 in terms of 53,490 and 46,590, so you get your first half of your installment in present value terms in half year's time is the percentage is 53.49%, because you get 53,490 in terms of present values after 6 months period, and the balance 46,510 in terms of present value you get after 1 year is 46.51, right? So if you really look at the the actual maturity, I will first use the word actual maturity. So 53.49% of your loan will be recovered within half year, and 46.5% of your loan will be recovered after 1 year. So that means the maturity, real maturity is 0.7326, right? So even though we say this is a loan to be repaid after 1 year, so if somebody asks from the you will tell the maturity of this loan is 1 year loan, which need to be paid on equal installments, like equal principals amounts of half yearly basis. But if you really look at the weights of each cash flows in terms of present values, your maturity is only 0.7326 years. So it's roughly about 9 months, close to 9 months, right? So which is we call the duration. Clear? So when you say the maturity, you would say maturity 1 year. But if you really work out in terms of present value, cash flows, present values, it is only 0.7326 years for you to get fully recover the amount, right? So which is the concept we call the duration. So if somebody asks, okay, tell me what is the duration of this particular loan, you would say it's only 0.73 years. If you really convert into number of months, it would be closer to 9 months, right? Okay, clear? So that is the concept of duration. We will move on and we will learn the theory, real theory. So this is a very simple example to start with, the concept of duration. Okay. Now, in mathematical model, I mean, don't get confused, but if you look at that is called duration, we call Macaulay duration and modified duration. Probably those who are working in risk departments know exactly, but we will look at little later the difference. But if you really look at from mathematical perspective, okay, so this is the formula to work out duration. So I will go to the right hand side, the formula. So it's basically a summation of multiplication of present value into time factor. So time means what you do is you take each cash flow, okay, each cash flow and multiply by and each cash flow of the particular asset or liability and take the present value of that cash flow multiply by the time factor. Time factor is, let's say, a 5-year loan. If it is a 5-year loan, for simplicity, I will take a very simple example which need to be paid in five installment of at the end of the year. So that's basically 5 installments to be paid annually. Okay. So there are how many cash flows in that case? How many cash flows? Can someone tell? For a 5-year loan to be paid annually over a 5-year period, so how many cash flows?
Five cash flows.
5 cash flows, because if it is annually over a 5-year period, 5 cash flows. So there are time intervals: first year, second year, third year, fourth year, 5 year. So if you take each cash flow of the loan and take the present value of each cash flow, multiply by the relevant time factor. That means the first year cash flow, take the present value multiplied by 1. Then you take the second year cash flow, take the present value multiplied by 2. Okay, time factor is 2 because 2 years. If you take third year cash flow, take the cash flow, take the present value and multiply by 3. And so that is what is represented by this part, top part, okay, numerator, present value of time factor times t divided by the summation of present values. So we don't take the time factor here. So this is, can anyone tell the bottom part, denominator, what is, when you take the present value of cash flows in a financial instrument, what is the meaning of that? What is that really explain? Anyone?
That will be the loan amount. But the loan amount we have given.
Yeah, it's not okay. You are somewhat closer, but it is really the market value of your loan or whatever the instrument, financial instruments. It's the market value. Because basically the price, right? Okay. At any given point in time, the price of your instrument, asset or liability. So that is basically the summation of present value represent. So anytime, if you now let's say, because interest rate related instrument, any point of time, the price changes. Because the price changes because of the interest rate changes. Because now here the interest rate means not the agreed interest rate to be paid upon, right? But the what you call the market risk arise because of the change in the yield. Now, for example, let's say you give a loan at 12% 1 year ago. Okay, so fixed interest rate for 5 years. So even the market interest rate change, you are entitled to that what you call 12% or whatever you agreed. So that won't change. But let's say now the market interest rate of a similar loan is 10% or 15%. So reality, your value of the loan changes. That is market value. So, price. So that is here what we talk about the change. But you will still earn 12% on your loan if it is a fixed rate. So that is we consider the price, right? Now, typically, if you take an investment bond, because now generally you don't sell loans. I mean, some other countries you sell loan, but here in Sri Lanka you don't sell loans. I think you don't market. But now, if you take a bond, now let's say you invested in a bond for trading purpose, right? Trading purpose, and the bond has two elements. What are the two elements a bond has? Anybody before we move on to that part? We will discuss it later, but can someone tell, though some of you working in treasuries and other, investment related, divisions. So what are the two key elements when we talk about a bond? Interest rate. In terms of interest rate, yeah. What are two things? Yes, somebody wanted to. Can someone tell? These are very basic things.
Coupon rate and yield to maturity.
Exactly, Kasturi. No, you are Kasturi. Yes.
Yes.
Yeah, you're right. The coupon rate and the yield to maturity. So those are the two elements we talk about. So the coupon rate is the fixed one. Now, if you invest in a 8% coupon, you get 8% over your period. So that won't change. That's like your interest in a loan. So today you invest in an 8% coupon bond. Maybe 1 year later, the market interest rate drops to 6% or maybe rise to 10%. You still get your 8%, right? But the yield changes. That is the interest rate required by the participant changes. That is called the required rate of return. The term you told was right, the yield to maturity. When the yield to maturity changes, what happens? The price of your bond changes. So that means if you had a current price, it will change depending on the movement of interest rate in either direction. Sometimes, it will go up or it will come down. So those are the two factors. So the price will change, but your coupon will stay same and you will receive the fixed coupon, right? So important is the interest rate, that is the yield and the coupon, right? So which derive the present value, right? Clear? So, so this is the price part, okay? Now, so here when we talk about the interest rate related instruments, always few important points to remember. There is what is called zero coupon bond. So what do you mean by zero coupon bonds? Means you don't have coupons in between. Now in Sri Lanka, we don't really have zero coupon bond, but which is similar to a treasury bill product. It's almost similar to treasury bill product because you don't have in between cash flows, you have a maturity. You will get the interest at the maturity, right? So it's a discounted instrument. Now, if you look at treasury bond, it's a discounted instrument. Okay, you invest some amount and you get the face value at the maturity. So zero coupon bonds are long-term bonds which you don't get any coupons in between, but you will get the maturity proceeds or the face value at the time of maturity. So in a zero coupon bond, the important feature is the duration is same as the maturity. So there is no difference. Now when someone say it's a 5-year zero coupon bond, you are asked to compute the duration. What is the duration? In a 5-year zero coupon bond, what is the duration? Hmm?
5 years.
5 years. Pretty simple. Okay? Because maturity and duration same. You don't have to work out in mathematics. So it's same, 5 years. Okay? So 10 years zero coupon bond, the maturity is 10 years, duration also 10 years. Now, important factor is when interest rate changes, duration also changes. So that is the part for our market risk management. When the interest rate changes, duration changes. Okay. Now, this is what I explained earlier in this formula. Okay. So the denominator, the bottom part, is the discounted present value of a security or its price in an efficient market. Right. So this is the denominator, which I already explained this part. And numerator, the present value weighted by the length of time it takes to receive the cash flow. So that is the present value of the cash flow multiplied by the time factor. And so that is called the numerator. So this part, right? So it's very simple terms. So the duration is that. Duration is the present value of future cash flows multiplied by the time factor, the time to maturity of the cash flow divided by the price is called the duration. Okay. Now, look at duration versus maturity. Now, take a very classic example. I mean, just to explanation. Now, hypothetical cases. Now, if you take a 10 million loan, now principal plus interest paid in 20 years. Okay. So the principal plus interest paid in 20 years, 10 million loan, entire principal plus interest paid in 20 years, right? So what is the maturity of the loan?
In 20 years.
20 years. So maturity is 20 years basically. So what is the duration? Can someone work out the duration?
Duration also 20 years. If we count
Duration also
20 years.
12 or 20?
20.
20.
Yeah.
Okay. Yeah. So now here in between there aren't any cash flows because your entire principal and interest to be paid in 20 years. So that means in between there aren't any cash flows. No? So if you look at the formula, so in between there are no only one cash flow. So basically duration and maturity should be the same. So your what you call duration also 20 years. Maturity 20 years. Now let's look at this one. Now same 10 million loan. Now let's say to be paid in a different way. Now, this is a hypothetical example, but just to explain the concept. Now, of this 10 million loan, the bank has asked the customer to pay 9 million principal in first year, 1 million principal in 20 years. Just a hypothetical example, right? So you are given a 10 million loan, but say, okay, pay me 9 million in the first year and pay me the balance 1 million after 20 years. So what is the maturity? What is the maturity? Can someone tell? Huh? What about others? What is the maturity? Anyone?
Maturity is 20 years, but in between two cash flows.
Yeah, exactly. You are right. Maturity is 20 years because anyway, you will recover the loan after 20 years, no? You will recover the loan after 20 years. It's true that there are in between cash flows. Okay, so if you look at the maturity, it's 20 years. But if you just take some cash flows, how the timing of the cash flows, okay, 9 out of 10 will be received after 1 year, 1 out of 10 will receive after 20 years. I'm not looking at any present value factors, just a cash flow, the timing factor of cash flow. So effectively, you will receive your cash flows within a 2.9 years because of even maturity is 20 years, which you recover your loan fully, but 9 million will be received after 1 year and 1 million only after 20 years. So effectively, from a mathematical point of view, the maturity would be, mathematical maturity would be 2.9 years. Okay. So it's a rough estimate of a duration. This is not the duration, but it's a rough estimate. Okay. So just to show the concept. So if you take this loan, the second example, the maturity will, somebody would say maturity is 20 years. But in reality, real maturity is only 2.9 years. Right? So this is called the concept of duration. This is not exactly the duration, but for the explanation purpose, that is the reference. So the maturity is 20 years, duration is only 2.9 years. So that's why it's very important that the duration model is more effective in managing interest rate because it captures the actual, the real duration, real maturity, which is the duration. Okay, so we will move on to some technical stuff. Okay, technical concept. Now, if you look at this, already explained to you, zero coupon bond, duration equal maturity. So if duration 15 years, maturity also 15 years. Now, there is another type of bonds called console bonds. In console bonds, you don't have any maturity. So no maturity, it's a perpetual bond. But you get a fixed coupon at the end of each year. You get a fixed coupon, right? So in a fixed such a bond, maturity is infinite. No maturity means infinite. It's like a share. Now, if you look at a real share, there is no maturity, no. If you invest in a share, there is no maturity. It will not mature, right? So similarly, console bond, it will not mature. It's a perpetual bond, right? But you will get a coupon at the end of the year. Then in such a bond, it's very simple. The duration equal 1 plus 1 divided by the R means the yield to maturity. So anytime, if you know the yield to maturity of this particular bond, you can find out the duration, right? Now, if you take a console bond with 4% coupon and 5% yield, so what is the duration? 1 plus 1 divided by 0.05. Console bond with 4% coupon. The coupon is the fixed coupon you get, you earn from the bond, but 5% is the yield to maturity, right? Okay, so let's move on to the concept of duration. Okay. Now,
Sir, excuse me.
yeah,
What is the example for this console bond? Where in Sri Lanka it is applicable?
I don't think we have issued any console bonds here in Sri Lanka, but if you want to issue a console bond, it is there in certain countries. Because now it's like a share, Now, only difference is share and a console bond. Now, there may be investors who only interested in a fixed coupon. They don't want to get a, what you call maturity proceeds. Now, usually, even certain countries, even coupon bonds are going up to 40, 60 years, Basically, the very long-term funds who want to maintain some fixed interest, they are not concerned about maturity. Okay, like investors like long-term funds, the pension funds, insurance funds, and so on. Yeah, they are not worried about a maturity, but generally these bonds pay a very good interest rate, coupon, right? So when you invest, so throughout the period till your lifetime, even beyond your lifetime, somebody else's lifetime, if you have this bond in your investment portfolio, you will get that. If the coupon is 10%, you get 10%, right? Now, in a share, because sometimes the investors would try to invest in these sort of console bond rather than investing in equity. Equity, the problem is shareholders may get a dividend, may not get a dividend. Okay. Now, in fact, this is something, this is similar to a non-redeemable, non-cumulative preference shares, right? Preference shares, so it's similar to non-redeemable, non-cumulative preference shares, right? So you get a fixed coupon, but no maturity. Okay, but we don't say here in Sri Lanka console bond, but still sometimes it is popular, the preference shares, right? Sometimes you have seen in certain companies, they used to issue preference shares because they get a preferential right over the ordinary shareholders. So it's a fixed coupon at the end of each year, no maturity. So it's something like a non-cumulative, non-redeemable preference shares, right? Okay.
Okay.
So let's look at how do you work out the duration of a interest-related instrument. Take example for bond. Now, when you take interest rate-related instrument, there are few things you need to be mindful of. So one is each such instrument you have a face value, right? Okay, original the face value, the maturity proceeds. Okay, and then we have market interest rate, which is called the yield to maturity, the required rate of return. Then you have the maturity, and then you have the coupon. So this is the coupon you get at each period, depending on what you call how frequent you are getting the coupon. Now I want to explain now, this is the formula we looked at. Okay, so how do we work out? Very simple example. If you take 1,000 face value bond, the face value is the maturity amount, which is called the face value. Then coupon is calculated based on the face value. Okay. So how many cash flows this particular instrument has? How many cash flows?
3 cash flows.
3 cash flows. Okay, 3 cash flows. So first year you get the coupon. Okay, coupon, that is 10% of the face value 100. The second year you also get the coupon 100. Third year you get the coupon 100 plus your maturity value. Maturity value is 1000. So the 3 cash flows: first year 100, second year 100, third year it is 1000 plus. I have separated it, but it's 100 plus 1000, that is 1100. So as per our formula, remember our formula is present value. I will go back again. Present value of each cash flow multiplied by the time factor divided by the present value of cash flows. The bottom part is, this part is not there. Okay. I think this part you have, I think most of your banks, you know about this, just for a benefit of some people who don't know. So the present value is, now if you look at yield to maturity rate per annum is 5%. In order to get the present value, you have to divide it by 1.0.5, the first year cash flow to the power 1. The second year present value is 100 divided by 1.05 to the power 2. Okay. Then we have to multiply by the time factor, the second year, 2. Third year, 100 divided by 1.05 to the power 3, that is the present value, multiply by 3, the time factor. Then we have this 1000 cash flow again, 1.0 divided by 1.05 to the power 3, multiplied by 3. So you can combine these two really, but for the explanation purpose, I put as a two components. So this is the top part. Then divided by the present value. The present value is simply this one plus this one without time factor, this one. Okay, these without time factor, these are the amounts, right? This is same as, this has the power, this notation is power, same as this, somehow it has put it in a different way. So if you look at this particular bond, now the maturity is 3 years, but when you work out the actual maturity, which is the duration, actual in the sense weighted maturity is 2.75 years. Okay. So if someone asks, okay, what is the duration of this particular bond? You can use this formula and say 2.75 years. Now, what is the importance of this factor? Now, take example of a bank. Okay. Now, bank has this particular bond. Okay. This is the only asset in the bank, right? Maturity, only asset in the bank. So maturity is 3 years. Okay. So now you are the risk manager. Okay. So you follow the maturity model. Forget about the duration. Maturity model for your risk management, which we learned last week. Okay. So in order to manage the risk, what do you do if you follow the maturity model? Because this is 3-year maturity instrument. So this is the only asset you have in your, what you call the balance sheet. So you are the risk manager. Now you want to manage the interest rate risk. And you follow the maturity model. So we discussed the maturity model last week. So what do you do? The best way to manage the interest rate risk using the maturity model? Tell me. I'm not asking duration, anything. Last week stuff. What is the best way? There are many ways, but what is the best way? Can someone? I think we it's better that if we can discuss, talk. What is the best way? Many ways, but what is the best possible way? Best way. I'm asking the best possible way. This is the only asset you have. No more assets. One and only one asset. Can someone tell? So you have to understand these things. Now here, what we need is the real practical things, not just theory, but how do you look at a scenario? This is the purpose. So if you understood the principle, I ask you very pretty simple thing I am asking. What is the best thing?
To have a liability which is similar to the same maturity of asset is 3 years, similar maturity of 3 years for the liability, then there will be a maturity gap will be 0.
Okay, Kasturi, you are right. So simple, no? Because now what we said under the maturity model, if we can make maturity gap equal to 0, that is the best. MA equal ML, MA minus ML equals 0. That is the best. But what I said even this morning, in practice it is difficult. But we should try to minimize the gap, narrow the gap. If we can make MA minus ML closer to 0, you are very comfortable. So don't make a big gap. Remember, we looked at few examples also. How when the maturity gap, widen and the even slight interest rate movement will have adverse impact on equity. Okay. So remember, so the best way, like what Kasturi, no?
Yes.
Okay. So it's very simple. I mean, in practical sense, it may be not possible, but I ask the best way. Best way is if you can have a liability, create a liability in your balance sheet, exactly matching maturity of 3 years, you are well off because your maturity of asset equal maturity of liability. So maturity gap would be 0. So if you follow the maturity gap model, you are satisfied. You are cover up to 100%. Right? So that is the best way. I am talking about a simple example, one asset, one liability. But when we compute the duration, okay, duration is quite different, right? Now, duration is only 2.5 years. So what does it mean? Even though maturity is 3 years, duration is 2.75 years. So that's why we say, remember I started why we went to the maturity duration model is a better model than the maturity. For two things, it does not capture the leverage. The maturity model does not capture the leverage and the time to maturity. That is the duration. So even though now you will see, since the duration is different, even though use that particular 3-year maturity liability, you will not fully hedge. Okay. So because of your duration is 2.75 years. In reality, so what does it mean is, okay, when you have this sort of a 3-year maturity bond, probably you will be fully hedged if you use a 2.75 years maturity. So liability with a 2.75 years duration, not the maturity. Right? So that is the idea. Right? So duration is somewhat better concept. So even if you match two assets and liabilities using duration, it may not fully hedge because durations are a little bit different. So that's the concept I want to explain. Now look at some features of duration and maturity. The duration increases with maturity at a decreasing rate. What do you mean by that? When the maturity increases, duration also increases. But as you move on over a longer maturity, the duration increase is slow, right? That means, okay, maturity is 10 years, maturity is 15 years, duration also, increases similarly. But as time moves on, for longer term maturity, the increase in duration is slower. Duration will not increase at the same speed the maturity increases, right? So that is why in mathematical notations, these are just for your explanation, don't worry. Those who know, have done mathematics know, delta D is change in duration divided by delta M greater than 0. The first, differentiation is greater than 0, but the second differentiation is less than 0, means the rate speed will be slower. Okay, so basically now you can, what you know is when the duration increases, maturity also increases. Maturity increases, duration also increases at a slower rate. Then however the yield on a security, lower the duration. Okay. Now when the yield on an instrument is higher, the duration is lower. Delta D, the first differentiation of delta D over delta R less than 0. Similarly, higher the coupon rate, the lower the duration. Higher the coupon rate, lower the duration. Okay. Higher the coupon rate, lower the duration, right? Now, why these things are important? Now, these are important elements when you want to manage your interest rate risk and identify the right products. When you want to identify the right product to manage your interest rate risk, these concepts are important. Okay. So if you want to get a longer duration instrument, you should always go for what sort of a yield? Now let's say, now in order to manage your interest rate risk, you want the interest rate related instrument, coupon product to manage your interest rate, okay? But you want a higher duration security, higher duration, okay? So you have two bonds in the market, two bonds. One is 10-year bond, okay, 10-year bond, okay. One is a bond paying what you call the 5%. Market yield is 5%. The other one is 6%. Okay, one bond is paying 5%, and other bond is paying 6% yield to maturity. But you want to select a higher duration instrument. So which one you select? Which one? Can someone tell?
5%.
5%. 5%.
Yeah. Okay, 5% because it will have a higher
High.
duration.
Education.
Higher duration, right? Okay. So these are important things when you really practice. Okay, really engage in the risk management part for you to take decisions, right? Now, economic meaning of duration, it is in addition to being weighted average time to maturity of an asset liability, it is a direct measure of interest rate sensitivity or elasticity of an asset or liability. Okay, so it's a direct measure of interest rate sensitivity or elasticity. So that it means how the price related to interest rate movements. So it's a measure of interest rate sensitivity. Now, again, if you put at very simple terms of individual asset or liability, so it's the duration is an approximation. Approximation. Now, I have used this, sign, what is called approximation, to change in price minus change in price divided by change in interest rate. That is change in the market yield, right? So the change in price divided by change in interest rate equal to minus D times, D means duration, times change in interest rate divided by 1 plus R, right? So the longer the maturity, the larger change in price for a given change in R. Okay, so this is a pretty simple formula. I will put simplify it further later. Okay, when I explained earlier, I said there is two concepts called Macaulay duration and modified duration. Now, modified version of a Macaulay duration allows market participants to estimate the relative price volatility. Okay, so change in price divided by price equal Macaulay duration, which we learned so far. This one, Macaulay duration, divided by 1 plus R times delta R. Okay, so we can say Macaulay duration divided by 1 plus R as the modified duration. So the modified duration, so the change in price, that is percentage change in price, this part approximately equal to modified duration, this part times change R. So we do this approximation using Macaulay duration to measure the interest rate sensitivity or the price volatility. So that change in price equal to modified duration times change in interest rate, right? So very simple terms, I will put in very simple terms all these things what we discussed. Now, if you take an individual asset, change in price of that particular asset divided by the original price as a result of interest rate movements equal minus, always remember minus sign, D duration, okay, Macaulay duration times delta R divided by 1 plus R. So this is very simple. So change in price divided by price time equal minus D times delta R, that is the change in market interest rate divided by 1 plus R. Then similarly, we can modify it to any balance sheet change. Change in assets of a value of assets in a balance sheet equal change in value of assets divided by the original value of assets equal minus DA. Now DA stands for duration of assets. Now I am modifying it to the entire balance sheet. Minus DA times delta R divided by 1 plus R, right? Then change in liabilities divided by liabilities equal minus DL times delta R divided by 1 plus R. right? So this is the formula. So if you can remember this formula, it's pretty simple. So this is the concept we use throughout our duration model. So if we move on to the entire balance sheet equity impact, so change in equity means change in asset value minus change in liability, because any change in asset and liability will change the equity. So if you combine those two, we can end up with this particular formula: change in equity equal minus, remember minus, and within bracket dA minus KDL times, this asterisk means multiplication, asset value multiplied by liability value into change in interest rate divided by 1 plus R. And what is K? K is L over A. L means liabilities, A means asset. That is a leverage. Remember when I said why maturity model is not effective, we ignore the leverage factor. But here if you look at duration model, we take leverage factor, right? So remember, this is the important formula for you all. So these formulas like individual assets, individual asset and the total balance sheet asset and liability, finally to the entire balance sheet impact. So this is the Bible. Okay, this is what you have to be carefully understand when you measure the interest rate risk impact for the entire balance sheet of your bank or the financial institution. Okay, so this is very simple formula. So change in equity. Now, if you want to assess the impact on your equity as a result of interest rate changes, simply you can use this formula. So this is the formula we are going to use throughout this program, right? So this is what we are going to use. So change in equity equal minus dA minus KDL times A times delta R divided by 1 plus R. So what is dA? Duration of entire balance sheet asset, duration of assets, minus K, leverage factor, times duration of liabilities multiplied by total assets into change in interest rate divided by 1 plus R. So now, as risk managers, what is our target? Now, what do you want to do? As risk managers, what we want to do? What is our ultimate objective? What is your ultimate objective? Can someone tell? As risk managers, what is our ultimate objective? Can someone tell? What is your ultimate objective on all this exercise? What do you want? Oh, objective. What is your final objective?
Minimizing the risk of bank portfolio.
Sorry?
Minimizing the risk of bank portfolio.
Yeah, minimize the risk. If you put it a little bit, minimize the risk is right, but what you want to finally achieve? Okay. As a result of risk, what happens? What your objective is to minimize impact on equity. As a result of interest rate raise, what is the problem? It will have impact on our equity, isn't it? If there is significant interest rate movements against us, and finally what could happen? Our equity will decline. That is our problem. So we want to ensure our delta E impact is very small. Okay. So if we can make delta E 0, that is the best scenario. That means no impact. If you can ensure through our risk management, our impact is 0, that is delta E. That is change in delta is the change in equity. Change in equity 0 means there is no change. Then that is the best ideal. In practice, it is not possible. Ideal. So if we want to do that, what we should do? Can someone tell? For ideal situation, what is the best way? What is the best way to achieve that ideal situation? What's the best thing you can do to achieve the ideal situation? Can someone tell? What is the best way? Can someone tell the best way? Best way, if you can make this part dA minus KDL 0, that is the best way. So this is the only possibility. We cannot do anything else other than this. If we can make this component 0, then what happens? Change in equity will become 0. Right? So how do you make this 0? Is simply you have to make dA equal KDL. Yeah. The best way, I am asking the best way, not the practical way. The best way, if we can make dA equal KDL, definitely you will have no impact on your equity. So, but practically, what we want to do is ensure this part is somewhat minimized or closer to 0. If we can make this part, because we don't have any control on interest rate. There is asset value, we can't make asset value 0. No, if you do asset 0, you don't have any business. So what we have to do is we have to structure our balance sheet in such a way this part is closer to 0, in the sense with a minimum value, minimize as much as. So this is called the duration gap. So if we can make the duration gap closer to 0 or minimize, then we can manage change comfortably. So that is called the duration hedging, right? Clear? Any questions? Anything? Okay, so that is the duty of the risk manager. So duration, if your bank risk manager follows duration hedging, always his duty should be to look at the duration structure of assets and liabilities and take the leverage and see the impact on equity arising from movement of interest rate. And whenever he see significant risk arise, he need to ensure the relevant, maybe the board or senior management to restructure the balance sheet to minimize any significant risk using adjusting DAs and DLs, right? So what are the steps in duration gap analysis? You have to forecast interest rate. You have to see what is going to happen. Okay, it's a dynamic concept. Then you have to estimate market value of assets and liabilities Because when we talk about duration model, we have to take the present values, means the market values on cash flow and the time factor. Then we have to estimate market values in order to compute duration. Then we have to estimate the weighted average duration of assets and liabilities. Because when you take the entire balance sheet, you have to take the weighted average. Remember when we looked at the maturities, we did the maturities weighted average. Similarly, for these duration and forecasting the changes in the market value of stakeholders' equity across different interest rate environments. So then use the duration concept and then forecast the changes in the market value of equity, that is this part, across different interest rate environment. That is, interest rate move up by certain percentage, interest will move down by certain percentage, and see what could be the impact depending on your forecast. Right? So the bank can protect either the market value of the equity or the book value of net interest income, but not both. So you can decide which one you prefer. You can look at the repricing gap model and manage that, or you can look at the market value changes in equity and manage that to protect your bank from interest rate risk. To follow the market value change of equity, so bank should set the D gap to 0, that is DA minus KDL 0. That is ideal. But as I said, you must minimize D gap. DA is the weighted average duration of assets. DL is the weighted average duration of liabilities. Right? Okay, let's move on to example. Okay. So very simple hypothetical balance sheet. Hypothetical balance sheet. It has cash 100. The commercial loans, 5-year loans of 700 par. Par value means the face value. The coupon is 12%. And the maturity 3 years. So current maturity 3 years. Treasury bond 6 years. The par value is 200. Coupon 8%. And the maturity, remaining maturity is 6 years. Okay. The total cash earning assets 900. Those are the two assets. The total assets 1000. Now, if you look at the market values also 700 and 200. Why? Because the yield to maturities are also same. If the yield to maturity is 12% and the coupon 12%, the market value is same as the face value. Okay. So here also yield to maturity 8%. So the market value also 200, same as par value. Then total cash earning assets 900. Okay. The total assets. Okay. Yield to maturity 10%. Market value is 1000 because of this market value 100, 700 and 200 altogether 1000. So the duration, now when you compute the duration of this 3-year maturity loans are only 2.69. 2.69, right? And duration of this 6-year maturity bonds are 4.99, 8% coupon, 8% maturity. So the total duration, weighted average duration is 2.88. How did you go? 2.88 is the weighted averages of these two, right? These two. So then, if you move on to the interest rate, the liability side, we have term deposit 1-year maturity, 5% coupon, and yield to maturity 5%. So the par value and the market value same. The duration is only 1 year. Other deposit set CD of 3 years, face value 300, 7% coupon. So the maturity is 3 years. If yield to maturity is 7%, simplicity, I have used the same yield to maturity. It may vary. So the market value 300. So your duration is 2.81. So the total interest-bearing liability is 920 and the equity 80. So the balance sheet asset total liabilities and equity 1000. So the weighted average duration of liabilities are 1.959, right? So let's look at the duration model and compute the duration gap. Okay, so how did you get 2.88? 2.88, remember this one. How did you get this one? It's the weight of this one. You will see 2.700 divided by 1000. 700 divided by 1000, weight of this particular asset, into 2.69 individual duration. Then this asset 200 divided by 1000 into 4.99. 200 divided by 1000 into 4.99, you get 2.88. So this is the weighted average duration of assets 2.8. This is the one we need for this formula. We need DA. Then DL equal 620 divided by 920. Because total liabilities value is 920, 620 divided by 920 multiplied by 1, and 300 divided by 920 multiplied by 2.81, 1.59. So now we can compute duration gap. Duration gap equal duration gap DA minus KDL. Okay, so DA is 2.88. minus KDL. KDL is what? K means L over A. L 920, A 1000 times 1.59 DL. So the duration gap of this particular balance sheet is 1.42 years. So this is the measure we are looking for in managing interest rate. So if you, in other words, this particular bank, hypothetical bank, has a duration gap of 1.42 years. So this has a positive duration gap. So positive duration gap. So when you have a positive duration gap means duration of assets greater than duration of liabilities. So that means the asset value changed by more than liability value for particular interest rate changes. Okay. So now how it impact the market value of our equity. So we can go to our original formula, a simple formula. This one. Change in equity equal minus DA minus KDL times asset times delta rho 1 plus R. So we can use that formula. So change in, I will straight away go to this part. Don't worry about this formula part. So change in equity equal minus duration gap. So the minus duration gap we computed 1.42 earlier. Change in interest rate, let's say 1%, when 1% interest rate, 0.01 plus current overall interest rate, 10%, times the asset value, 1000. So our market value in this particular bank, if our interest rate goes up by 1%, the market value declined by 12.9 million. So that means in this particular bank, if interest rate goes up by 1%, our market value of equity, that means equity will decline by 12.8. 80 drop by 12.8 to 67 point something. 12.9. So almost 67.1. So basically, that's about 15% drop, almost more than 15% drop. 12.9 divided by 80 means 50. So that means for 1% interest rate change, even then if you look at duration gap is only 1.42, but there's a 15% drop. So this gives the gravity level of interest rate risk. Now by chance, if the interest rate goes up by 2%, this will almost double. So this way, for the risk manager can do some scenario analysis. What could be the impact on your balance sheet if interest rate changes by a particular amount? Okay. So it could be either way, negative impact as well as positive impact. And when you see significant negative impact, you can restructure your balance sheet in terms of duration of assets and liabilities. So that is called the duration hedging. That is the whole purpose of this duration modeling. Right? Any questions so far? Okay, so let's look at the interpretations of positive and negative D gap. Now, positive D gap indicates that the assets are more price sensitive than liabilities on average. So when interest rate rises, the assets will fall proportionately more because the relationship between the interest rate and the fixed interest rate related instruments are negative. When the interest rate goes up, price decline, interest rate goes down, price goes up. So when interest rate rises, the assets will fall proportionately more in value than liability. So the market value of equity will fall. But when you have a negative duration gap, what happens? That means you have more liabilities, price sensitive, than the assets. Okay. So that means when interest rate rises, the liabilities interest rate fall is more than the value of assets. So that means the market value of equity rise because they were getting a positive impact. Okay, positive impact. So that is the interpretation of D gap. Okay. Now, D gap analysis has the advantage of focusing on all cash flows. Now, this is the importance compared to the pricing gap. Now, pricing gap, we only consider the rate sensitive assets and liability, repricing gap. But here, all cash flows. Okay. And it's a more long term. and it measures interest rate risk in one number, duration. Okay. Always, if you look at many fund managers, for their hedging purpose, like long-term funds, this is the instrument they use. So they want to maintain duration at a particular level. They don't want to see duration changes beyond that. So that is the duration is the number they use among many fund managers, right, as the risk indicator. So whenever interest rate change, duration changes, that means they have to take measures. Okay. How many of you in banks use this duration for hedging purpose? Any, at least if you know, maybe you may not have. How many of your banks, at least for this fund management parts? Anyone heard about it? Anyone? Please ask your sorry. Please ask your colleagues. I think there are risk managers, some risk managers also here. So definitely you must be using these things, especially large funds for hedging. Now, if you look at insurance companies, this may be one important concept they follow for their fund hedging, to match assets and liability mismatch. Anybody? Anybody want to say anything? Right. Okay. Any questions? Anything else? Will we move on to the questions? Okay. Actual workings in a little while, so you must be comfortable with this particular area. Anything? No? You are well thorough, comfortable. So please ask questions, clarify things. Don't keep them, without clarifying, because you will be having problem toward the last part. Because once we complete, that's it. So we will meet only at the exam. So please clarify things as we go on, because don't keep anything till last minute. Because there is no way that we can, discuss later. So as we go on, if you don't understand anything, please ask, clarify, so that you are comfortable. Because everything is linked to the other area. If you don't know duration, you can't do something else related, right? Okay. So let's look at speculating on DGAP. Now, if you really go into practice, it is difficult to consistently alter the gap or DGAP on balance sheet and increase earnings. Now, I mean, there are a lot of theories, formulas, but when it comes to risk management in practice, it's not easy task. Always, I mean, if you look at a bank, every single moment of time, your structure changes. Every single moment. So it's very difficult. So, but you have to be mindful, you have to monitor closely and mindful of any significant changes, significant impacts for any possible interest rate scenarios in the future. So when the management choose to change asset and liability maturities and no duration in anticipation of interest rate changes, it is placing a bet against forward rate agreement from the yield curve. Okay, so it's basically like a betting, because we never can predict to greater accuracy changes going to take place in the future. But we take a chance of, depending on certain market factors, economic factors, you take a chance, you bet on certain thing going to happen in the future and take some decisions. Sometimes it may not be 100% accurate, but it's like a betting. So you place a bet against forward rate agreement from the yield curve. So you expect the yield curve will move up or downwards in this rate in the future because of these things. Based on now, when you talk about risk management, your economic colleagues will help them. These are the possible things because of the fundamentals, current fundamentals, market, events. These are the possibilities going to happen. Market liquidity, inflation, and so many other factors. So now, because now when you take the long-term and short-term movement, the liquidity is important. Whether you are in a tight liquidity situation right now, and what would be the future liquidity situation, right? So that's important. So it's like a bet. I mean, you just assume it is going to happen. It may or it may not. And do the changes as per your guess. And generally, in practice, when you look at certain fundamentals, economic indicators, market conditions, these are the possibilities. That's how the interest rate moves, changes. As your expectations. So you derive your expectation into the practice. Okay. Any more questions? Okay, before that, we move on to convexity. Can we move on to a question? Small working. Okay, let's work out something. Now you know the formulas, everything. Okay, can we look at this one? I think it is in your slide, case 1, study 1. Can you compute the duration of a 6-year bond with 8% coupon, 8% yield, and face value 1000? Simply follow the formula. What is the formula? Duration equal numerator. What is the numerator? Can someone tell numerator? Formula numerator, top part.
Top
Huh?
top
Yes.
part of the
Yeah, can you tell what is it? Can someone tell? Tabodini? We just learned, I think, what is the numerator? How do you compute the duration? Can someone tell? I can't hear. Anyone? What is the duration? We just did. All of you are in the lecture somewhere else. If you were in the lecture, how do you compute the duration? Top part and bottom part. Can someone tell? Huh? This is not magic because we discussed all this time.
number of assigned number of
This is the formula. Duration is top part is present value of each cash flow multiplied by time factor divided by the summation of present values. So summation of present values of cash flow multiplied by each time factor divided by the summation of present value, which is the price. So this is the duration. Remember? Okay. We worked out one example. Okay. So pretty simple. So can you all start working on that? Because otherwise, you will not understand how to do it. So compute, because before moving to convexity, it is better we start with this. Okay. Compute the duration of a 6 year, only first part, duration of a 6-year bond. So the maturity is 6 years, 8% coupon, 8% yield. So it's pretty simple. And the face value is 1,000. 8% coupon, 8% yield, face value 1,000. So please compute the duration. Use the previous formula. Okay. So can you all start doing it? Can? Okay. So take about 5 minutes to do it. So use the previous example which I did earlier, similar to that. Please compute. So if you can compute, you are comfortable. Otherwise, you have to again work out. Right? Okay, can you all do it? Start. I will give you 5 minutes. Please try to do it carefully. Don't, you may make mistakes, but we will discuss once you complete it, because then you know what are your mistakes. So try to do it, yourself without any, assistance. Okay. And so when we discuss, you will realize what are your problems.
Answer is 1 duration,
How much?
1 year.
You have done the first part.
Yes, sir.
Okay. Any questions or anything? Okay. What about others? So we can move on to the discussion. What about others? Are they doing it or what? Have you all done? What about, please tell me that whether you are still doing or you have done, so that we can start working out.
Sir, I got duration as 4.99.
Okay. Okay. Anybody else? Anybody else?
Same answer, sir.
Okay. Everybody has done, whether you right or wrong, whether you have done, so we can move on. Please tell. Okay. So let's move on. Because, I mean, you have to talk. If you are not talking, I don't know. So let's move on to the answer. So let me catch up. Can you all see this? Can you all see this?
Yes, we can see the Excel.
Yes, sir. Yes,
Okay.
sir.
Okay, so let's look at, because I have put up in an Excel sheet. Now, this is a 6-year maturity bond. So there are 6 cash flows, 1, 2, 3, 4, 5, 6. And then this is a 8% coupon, 8% yield bond. Okay. So the coupon is 8% means of 1,000, face value is 1,000. So that means 80. So the 80, 5 cash flows 80. And the final cash flow is face value plus coupon 1,080. Now, discount factor is first year 1 divided by 1.08. So it's this much. Okay. That is 1 divided by 1.08. Okay. To the power 1. Okay. Then second year discount factor is 1 divided by 1.08 to the power 2, because A7 is power 2. And this is 1.01 divided by 1.08 to the power 3, 1.1 divided by 1.08 to the power 4, 1 divided by 1.08 to the power 5, 1 divided by 1.08 to the power 6, right? So the yield, so that is the discount factor. So the top part is the cash flow, the multiply by DFT, okay, multiply by the time, okay. So this into this, okay. So that means 80 multiplied by 0.958 into time, okay. So that is this much. Second one, 80 multiplied by 2 times this one. So likewise, when you do the numerator, the top part, that is summation of CFT, that is, present value of CFT, this one, multiplied by time factor is this much. Total summation is 4,992. And the bottom part, the denominator is the present value of cash flows. That is CFT times DFT come to 1,000. Okay, so the duration is CFT times DFT times T divided by 1,000, 4.99271. So this divided by this. Okay. So if you look at this bottom part of the equation, that is the denominator. Now the price is 1,000. So why price is 1,000? Because the face value also 1,000, because the coupon and the yield are same. So whenever the coupon and yield are the same, the face value and the price is also same, right? So so that is the reason that you get the price also as 1,000, right? So CFT DFT times T divided by 1,000. So the duration is 4.99271. Everybody got the answer? Anybody, any clarifications? Anything you need to clarify? Okay. Right? Everybody got 4.99? Anyone who haven't got? Anyone? No? Everybody got the answer? Please tell if you haven't got.
Yes, sir.
Anyone who haven't got? If you didn't get, please see what the mistake you did, right? So please see what is the mistake you did. And if you have any problem, please ask. So we continue to work on these lines now. No, okay. So if you are okay, we'll stop there. So we'll stop for a 15 minutes break, and we'll start after about 15 minutes. So if you have any further questions, we can clarify at that time, and we will continue with the remaining part. Okay, thank you. Okay, shall we move on to the next part of the question? We'll do, and then we'll come back to the convexity. Now, next part of the question is compute the price of this bond if the yield increases to 10%, right? Now earlier, the bond coupon is 8%, the yield is 8%. Now, if the yield increases to 10%, what could be the price of bond? Can you all work out, anybody worked out that part? Anyone? Has anyone worked out that part?
Is that answer is 998.186?
Okay, we'll see. I still I don't want to discuss. So now you got 998.16.
Yeah, 186.
18. Okay, so we'll wait. Anyone else? Any other answers? Anybody else got any other answers? Anyone who did and got any answer? Okay, if you have not done, please do it, and also you check your answer, please. The lady who just now talked, please check your answer whether you got the right answer. I think it may not be 998. It should be much higher, I think. Right? Because 2% increase, no? So it's 2% increase, no? It should be. Because if you do in practice only, if you get a question by chance in the exam, you should be able to work out. In real world, you are doing it in your computer models and all, that's fine. You don't have to worry about these working out mathematically. But in order to, identify in order to know whether you are doing the right way, that's why we are doing this question. But when it comes to your bank real practice, definitely you don't have any problem. Model gives you the answers. So, but from exam point of view, if you get a question like this, you should be able to work out manually. So that's why it's important for you all to work out individually and see whether you can still do it. So can you all start working on that, please? And those who completed second part, you go on to the third part. Now, third part of the question is basically compute the price of this bond if yield decreases to 6%. Right?
It is 5.04 answer.
Sorry?
I got answer as 5.04
But you get 5.04?
as duration.
Yeah. Now, what is the price? Now, the question,
1098.34.
that is the drop to 6% or increase to 10%.
Answer for the compute the price if yield decrease to 6%.
No, what I'm asking is answer to the question 2 is how much? The price of the bond if yield increases to 10%.
It was 912.89.
Okay, then answer to question number 3.
Price of the bond. It was 1098.34.
Okay, so use the same formula like what we did for the first part.
Yeah. Yeah.
Okay, okay. So we'll wait for others to do. So we will see whether you got the right answers.
Okay.
So I think someone told at the beginning that 990 or something. So just check your answer.
Okay.
Okay. We'll discuss together. I don't want to give the answer right now because otherwise others will not do the answer. So you keep your answers, all of your answers who completed straight away, and then we will discuss together. So once you complete, there's nothing magic here because simply use that formula. Now in the second question, only changes is the yield. So the discount factor changes from earlier 8% to 10%. So naturally price should be below because the increasing interest rate means price will come down. So you should get a price below face value. Then the third question, it's a decreasing yield. So only change is the discount factor will change from 8% to 6%. Right? So only change is that, so that definitely price should go up. So we'll wait for other colleagues to finish it before we discuss, because we will not discuss these calculations again and again. Maybe so that only in the exam, if you get a question, I don't know, question like this, anyway, you should be able to do it using simple calculations. At least when others complete part 2, please tell us so that we can do it and then move on to the part 3. At least 50% of the class complete, we can move on. Because I want all of you to do it yourself first, because otherwise, even if you make mistakes, you don't know.
Sir, is it 909 face value? Sorry, present value?
What is that?
For the second part, answer 909.
We will see. So you are, I think, somewhere closer. You are somewhere
Okay.
closer. I think maybe slight, maybe marginal adjustments or maybe calculations. I mean, approximations will, but it's somewhat closer. Yeah.
Okay, sir.
Okay. Now, what is important is at least try to work out these durations and all those stuff to 4 decimal places, because even a slight decimal change now could result in a significant, change. In your forex quotes also, you give four decimals, I think, when you quote forex. So if you work out with a very close approximation to like 1 decimal or 2 decimal, probably sometimes it may, final last row you can approximate, but the in between work is at least to 4 decimal places. So this may be the reason that you got 9, but I think earlier, the earlier, I don't know who spoke to me earlier. Who is that lady? I can't remember.
912.89, sir, it was.
Yeah, Lanka, no?
Yes.
Is that Lanka?
Yes, sir.
Okay, so Lanka is probably maybe, I think what I can remember, I can't remember the answer, but I think that's around that range, I think. Even other one 1098, probably that's what I can remember from my memory, but still I didn't see the answer. Okay, I think that, around that range, 912 and maybe 1098. So the subsequent lady, maybe some minor approximation errors could have resulted. So what about others? Because I want you to take time and do it at least once in your life, because sometimes certain courses you just do it, finish it off, and then forget everything. So just learn at least for one time, do it, so that you are comfortable. By chance, if you get a question, I don't know whether you will get a question of similar nature, but if you get a question, you should be able to work out the discount factors and all. This formula is very simple. This is the present value formula you use your entire life, bankers. Any calculations, all this fund managements, everything. If you look at pricing, all those, if you happen to work in a fund management division, basically, if you invest in equities and all, this is the formula. I mean, nothing else. You may using the different models like, different growth models, everything, but present value concept is same. If you look at fixed instrument, this is the formula you work out throughout. So now, so this is the first part. Let's move on to the increase to 10%, right? So as I said, only change is the discount factor. Now earlier the yield is 8, now discount yield is 10%. So your discount factor changes. Now that is 1 over 1.1. So that is the D3 is 1.1 to the time factor 1. So it is 1.1 to the time factor 2 and so on. So discount factor changes. So keep it for 4 decimal places. I think the person who got 99909, maybe you have worked out for discount factor a couple of decimals. So that may be the reason. So then this multiplied by this much is this one. So the numerator is this multiplied by this one. So total numerator value is 4,510, and divided by the price, your duration is 4.94. E12 divided by D12. But the price, the question is asking about the price. Price is 912.89. So I think someone told exactly 912.89. So this is there may be slight differences when you worked out, when you use the decimals, So it's about 912.89, right? Anything you need to clarify? No? Everybody fine with that? Now, what happened to the duration? Now, duration changes because interest rate, the yield increases, duration came down. Now, earlier duration was 4.99, now duration was 4.94. Remember, as the yield increases, duration come down. Okay, as the yield decreases, duration go up, right? So we'll go to the next part as well simultaneously. When the price, the yield drops to 6%, you see the price yield drops to 2%. What happened? Only change is the discount factor. Now instead of 8, now we have 6%, and you end up with what you call the numerator, the top part of the equation 5539, and bottom part of the equation 1098, which is the price, and the duration has now gone up because why? The yield came down. Now whenever yield come down, the duration increases. Right? Now you will understand why this concept is important. Now, for example, how many of you have managing the long-term funds in your bank, engaging? How many of you? Or maybe in the past. When you manage long-term funds and do investments, this is important. Now, you keep the duration. Now, you want to ensure, depending on the fund liabilities and fund cash flows, you want to maintain a particular duration, right? So, let's say your duration is you want to maintain between 5 to 6 or 5 to 7. So, you see, whenever this interest rate changes, the duration changes. So that you have to be mindful of the fact whether you are going to deviate from your target. So that's why the duration is very important. As I said, I mean, even a pretty simple Excel sheet gives these numbers without any problem. So the price is 1098.35. I think who is that earlier lady who called us got the answer 1098. So it is right. So please, others check. Okay, so that what mistakes you have done, right? Any questions? Anything you need to clarify? Anything you need to clarify? Okay, so if you don't have anything, let's move on to the fourth part of the question. Can you see the fourth part? No, I think.
Yes, sir. No.
Can you see?
No.
Okay. Okay, now can you see?
Now it's okay.
Okay. Now, so far in the part 2 and 3, what you did was that you used the normal bond pricing formula to compute the price of the bond. You know, simple formula. The numerator is the present value of cash flows multiplied by time factor divided by the present value of total cash flows, that is the price. So that is the formula which we discussed just now. Now we can do the same thing using the duration formula. Remember what is the duration formula we looked at? This is the simple duration formula. For an individual asset, the duration change in price over price equal minus d delta r divided by 1 plus r. Okay. So you can use the same formula, this formula for anything, for compute that, because we know the interest rate change, we know the current interest rate, and we know the what you call duration. We have computed the original duration. Okay. And then we know the current price, and we can compute the change in price, right? So now, can you all use the formula, the duration formula? This is the general formula for any asset. Change in price divided by price time equal minus the change in interest rate divided by 1 plus r to identify the new prices. Okay. So use the formula. Okay, use the formula. Okay. Okay, compute the price of the bond in 2 and 3 above. So this price of the bond using the duration model. So duration model equals what it says, change in price equal minus the price equal minus divided by price equal minus d times delta r over 1 plus r. So can you use that formula to compute the new prices? Now earlier you used the normal bond formula, now you use the duration formula, because in the question number 1 you worked out the duration of this particular bond. Okay. Now you know the duration of this particular bond, and then now use that formula to work out the price, new prices. So can you all do it?
Price change is minus 92.458.
92.458. So that means what is the new price?
Then the new price is 907.5.
Okay, we'll wait. I can't remember the answer. We'll wait. Okay. Then last part, have you done last part?
No, sir.
Okay. We'll see 907 point.
And 7.54.
Okay, 907. So we'll keep a note of it, whether others also get 907 point that answer. Anyone else, Lanka?
So
Huh?
calculating, sir.
Okay, okay. Anybody else?
For third part, it's 1092.45.
Okay, 1092.45.
Yes.
Okay, Anjali. Okay, anyone else got similar answers? One is 907 something, other one is 1092 point something. Yeah. Anyone get similar answers or different answers? Can we hear from our gentleman? No one is talking today. All ladies are in the front. Now, I think this is very important. So that's why I want all of you to do the question yourself, because otherwise you have to do, if there are any, I don't know what would be the structure, but if there is anything like that, you don't have any practice of doing at the exam. Okay, so please do it yourself, so that you know exactly what your mistake. Don't worry about mistakes. Doing mistakes here is not a problem, because here you don't have any problem, no. But if you don't know, and if you do mistakes in the exam, you will be in trouble. So please do it yourself. Okay, let's move on to the answers then. Can you all see this?
Yes, sir.
Okay, so the second, if the interest rate, the yield rise to 10%, price is earlier we computed 912.89, and the interest rate dropped to 6%. It is 1098.35. Now, if you look at the duration formula, what is the duration? Formula says the change in price equal divided by price equal minus D times delta R over 1 plus R. So if you compute that, it will come to 92.46, right? Because your original duration is this much, right? Okay. Okay. 92.46, the change. So that means whether it's an increase or decrease in the similar amount, you will get the same, change, because the formula is same. Only thing is the sign. When it is increases, you will have a drop. When it is decreases, you will have a gain. But the same amount to the price. It doesn't deviate because price says minus D. We know the D. D is this one, minus D, right? Times delta R. Delta R is how much? 0.02. Okay, delta R is 0.02. Divided by 1 plus R. 1 plus R means the original yield 1.08. So it's simply duration, the change is minus 4.993 times 0.02 divided by 1.08. Okay. In the case of decrease, delta R is negative. So that means minus minus positive. So you will get a positive change. In the case of increase, your delta R is positive because the increase positive 0.2 and minus D times minus 4.993 times that one comes to minus 92 points. So it's the same amount because the formula is same, only change in the sign. So when you deduct from 1000 original price 92.46, what do you get? 907.54. Is that what you got, Anjali?
Yes, sir.
Okay, 907.54. For the price, the yield decrease, you simply add 1000 plus 92.46, 1092.46. So it's basically the price is 1092.46 for the 6%. Okay, that is 6% interest rate, and for the 10%, the price is 907.54, right? So I think one lady got this one, others got the answer, right? Now, but if you look at the price used in the bond formula, it is different. You see? That is 1098.35. The one is 912.89. Right? So you see there's a difference. Now, when we use the normal formula, this is what we get. But if you use the duration formula, this is what we get. Okay, if you use the normal formula, this is what we get for increase, and if you use the duration formula, this is what we get, right? So what do you see? What do you see? What can you say? And what is the reason for that? What could be the reason for that? Whether something gone wrong?
In this formula, we use the duration that we calculated earlier. So it may be due to some decimal points missing or something.
No, it's not a mathematical problem. What do you think? What do you guess? And also the change is different. No? And this is also different. It's not the same difference. Now this is, I think, 5.89 higher. And this is 5.35 higher. It's not also same. Difference is also not the same, no? Right? Anyone can guess? Anybody can think of anything. Any views, thoughts? Any guesses? Okay. Now let me, can you all see the board? Let me explain. Now how this bond structure works. This is price, this is yield. Okay. Sorry, it's other way. This is yield, this is price. Right. So it's like this formula. So this is a graphical representation. So whenever the yield increases, price drops. Now you look at this point. Okay. Now let's say we are here at 5%. Okay. Now let's say interest rate goes up to 6%. Now our price is here at 5%. I will put P5. So interest rate increases to 6%. Our price will drop to P6. Right? Now take the other way. We take 4%. Interest rate drop to 4%. Then your price is P4. So price increase. So what do you see? What do you see? Whether this change and this change same. When interest rate drop to 4%, price is not same as interest rate increase to 6%, both 1% upward and 1% downwards, the price drops to 6%. So this increase and decrease, I say X1 and X2, not same. Right? Clear? So in here, let's say this is 5% and price is, let's say P5. And you will see,
Yes, we can see.
huh?
Yes, we can.
Okay.
Yes, sir. Yes.
Now let's say it went up to 6%. So when it went up to 6%, you see price will drop now. Price drop to P6. Sorry, P6, right? Is it clear?
Yes, sir.
Okay. Now let's say, so this is a 1% increase. So we do the same 1% decrease, 4%. So if interest rate drop to 4%, now say our price is here, P4. Right? Clear? Clear? What you see, now when the price increase, drop is this much. That is I tell X1. When the price, interest rate decrease, price increases X2. So what you observe from this graph? Anything you can see?
Even though the interest rate decreased by same percentage, the difference is not same.
I couldn't hear. Please, again.
Even though the interest rate changed by the same percentage, the difference
Yeah.
is not same.
Increase.
Even though the interest rate increase or decrease by the same percentage, the
Yes.
difference is not same.
Yeah,
When it
exactly.
is reducing,
Yeah. Okay, that's enough. So basically, your observation is when even the interest rate increase or decrease by the same percentage, the change is not same. That's exactly right. So why? Because this curve is not a straight line. This is not a straight line. This is called the convexity. This is not a straight line curve. This is not a curve like this. This is a straight line. This is a convex curve. Convex. So, but if it is a straight line that like this, then definitely same change should be same interest rate decline or increase should result in the same change. Okay, but of course in this curve for very minor interest rate changes. Now, I will draw here the curve again. Now, if you take this particular part, very slight interest rate changes, very small, not 5 to 6%. Let's say 5 to 5.01%. Okay, and 5 to 4.99%. Very small changes. This is right, because for very small changes, that part is a straight line, almost a straight line. But if you take a significant changes like this is not a straight line. So in our duration formula, we use a straight line methodology. It's a simple straight line. So the duration formula cannot be used for larger changes in interest rates. Right? So that is why we got different answers when we use the formula and when we use the normal, duration formula and the normal pricing formula. Clear? For very small changes, we can use the formula straight away. That is, formula is minus D times delta R over 1 plus R times price. Okay, so change in price equal this. right? But for larger changes, we can't use because of the convexity. This is not a straight line. Now, if the formula is like this, okay, but sorry, the curve is like this, okay, but curve is like this. Clear or not clear? Please tell. So that is the reason. So that's why we didn't, because either side we got the same answer when we use the duration formula. But we cannot use the duration formula because of the convexity for large interest rate changes. Now here we are talking about 2% either way. But let's say if we are talking about a very small means very small. Let's say 8% goes up to 8.01 or 8.02. Of course, we don't need to work out using the normal formula. We can use the duration formula, right? Any questions? Can you all see the presentation?
Yes, sir.
Okay. So that is the reason. Now, when we use the duration formula, we got 1092.46 and 907.54, which is the change is either way same. One is increase, one is decrease. But when we use the normal formula, we got a different answer because of this convexity factor, and the rate we are talking is about 2% increase or decrease either way. That's the reason. Because of the, so we cannot use this duration formula as it is. So far we learned for the large interest rate changes. When the interest rate changes significant amount, we cannot predict the change in pricing using this particular formula. Clear? So we will stop that question at that point, and we'll move to the lecture, and we'll do the rest of it once we cover that part in the lecture, right? Can you all see the presentation now? Can you all see the presentation?
No, sir.
Huh?
Yes, sir. No, we can't.
No. Okay. Okay, I'll shift to the presentation. Can now?
Yes, sir, it's okay.
Okay. So I think all of you have to talk. I think no one is talking except couple. I think we have to talk because this should be interactive session. This is not we are teaching academics to students in a university or maybe A-level student. So this is more practical. So you have to engage in the lecture. You have to talk. I think otherwise, very difficult for me also to understand whether you understood or not. Okay, even when I ask whether you did or not, no one is responding. I think at this maturity level, these courses, I think they should be more interactive. At least when I ask whether you did completed, you either have to say yes or no, whatever. Hopefully, at least from next week, we should have a somewhat interactive session. I think otherwise it will be a one-sided, just story. All of you have to engage in the lecture and identify problems. And even if you don't have questions, maybe at least to say yes or no whether you understood or not. Okay. So let's move on to the convexity. So we came to this point through that particular question. Why this? Sorry for some disturbance. Why this difference comes? Because of the convexity. Now, so duration does not capture the convexity. So basically, in the normal duration formula we talked, it does not capture the convexity. So we cannot use it to straight away measure the price impact. Okay, so it is because price and yield are inversely related, but not in a linear fashion. Remember, I showed you it's not a linear. So an increase in yield is associated with a drop in bond price, while decreasing in yield is associated with a rise in bond price. We saw any increase in the yield will result in the price to decline, and a decrease in yield will result in the price to rise. So the duration accurately measures the price sensitivity of fixed income securities for small changes in interest rate. Remember, for small changes, we can use the formula without any adjustment. But for large interest rate increases, duration overpredicts the fall in bond price. So it overpredicts the fall in bond price. While for large interest rate decreases, it underpredicts the increasing bond price. Okay, so it underpredicts the increasing bond price. Remember, that is what you saw in the question. For interest rate decreases, you see, it should be 1098, but it should, you show it at 1092. For large interest rate increases, it should be 912, but it shows as a 907. It is under predicting, right? Okay. So this is what I showed you in the board. So you see, because it's not a straight line, for large interest rate changes, you cannot, but for very small interest rate changes, you can use the formula. So now, for any interest rate change, we can use the convexity adjusted formula. Now we add here the convexity part. So it is the normal formula plus convexity factor adjusted. So now you can use this formula for anything that is change in price over price equal minus duration times delta R divided by 1 plus R plus half Cx. Now Cx is the degree of curvature. For each bond has a different curvature, right? It's different times change in interest rate to the power 2. So you know this component, we can use the modified duration. So it's modified duration times delta R plus same, 1/2 into Cx times delta R to the power 2. Okay. So we can use this formula for any change in interest rate because this will adjust the convexity. But if you want to use this formula without this part, then this formula is only applicable to very smaller change in interest rate. So this is the convexity adjusted duration formula. So let's look at how do you calculate the convexity of a bond, fixed income security. Now, the convexity of a fixed income security could be measured by the convexity, measured by 10 to the power 8, okay, times delta P minus divided by P plus delta P plus divided by P. So what do you mean by delta P minus P divided by P? The capital loss from 1 basis point in rise in interest rate, the yield, the negative impact. Delta P plus over P equal the capital gain from 1 basis point fall in yield, positive effect. So if we can if we can use the convexity using this formula, we can do the same. Give me a minute, please. Okay, so we can use the convexity adjusted formula for the computation of duration. So only thing is we need to compute the convexity. So convexity of any bond equal delta P minus, that is negative impact, plus positive impact, and add them together and take 10 to the power 8. Now this is power 10 to the power 8, 10 to the power 8, right? And if we further want to compute the equity impact, how to use the bank's estimates of a duration and convexity to solve for changes in R. Now, as you know, the accounting formula assets equal liabilities plus equity. So we can, we know equity, liabilities, and assets. So we can use this formula. Equity divided by assets equal B0 times delta R into dA. B0 is 1 over 1 plus R. Minus B0 L divided by A, that is leverage factor times DL. Remember first formula? This part is there in first formula as well. Where and multiplied by delta R plus B1 into delta R square. Now B1 is this, that is convexity of balance sheet assets and convexity of balance sheet liabilities divided by 2. So for your risk management purpose, now all these, when you inbuilt into your model, it will automatically give the impact on equity for any change in interest rate. Okay. So the bank has estimates for DA, DL, CXA, and CXL. It can obtain an estimate of the delta R that could cause it. So even if you go to the extent, what is the interest rate increase or decrease that could result in your bank to collapse? You know, so I mean, sort of a scenario analysis. So based on different change in interest rate, you can estimate the impact on your equity using this formula for anything, because this is not a straight line formula. This is for any convexity adjusted assets and liabilities in the balance sheet. Okay. So let's go back to the question again. The question we stopped. Okay, all of you have the question with you? Can you see the presentation, please?
Yes, we can see.
Can you see this slide?
Yes, sir.
Can?
Yes, sir.
Okay. Can no?
Yes, sir.
Okay. So now we have done up to 5, item number 5. Okay, we did the calculation using normal way. We computed using the duration formula, and we compared the results and commented. Now move on to the question number 6. Compute the price of a bond if the yield increases and decreases by 1 basis point using the bond formula. Okay. Compute the price of the bond if yield increases and decreases. Now again use the same formula, not the duration, same formula. If the yield increases by 1 basis point now, 1 basis point. Okay, so if it goes up by 1 basis point, what is the price? If it comes down by 1 basis point, what is the price? Use the same formula. Same formula. We use that question 1, 2, 3. Can you all do it quickly? So previously we worked out for 8 to 10, 8 to 6. Now, if the yield increases by 1 basis point and if the yield decreases by 1 basis point, what is the price using normal formula, not the duration? Let's work out the first part in the 0.01, that is one basis point increase. So let me move there. Okay. Hope you can see this. Okay. Now, can you all see this, please?
Yes, sir.
Okay.
Yes, sir.
Okay. So the first part is if the interest rate yield increases by 1 basis point means from 8% to 8.01. So 1 basis point means 1% of, because 1% means 100 basis point. So 1 basis point means 0.1%. So the new yield is 8.01 in decimal forms 0801. So simply your cash flows will not vary, the discount factor will vary. This is 1 divided by 1.0801 to the power 1. This is 1.0801 to the power 2, 1.0801 to the power 3, 4, 5, 6. Right? So then multiply by the time factor. So you get the numerator, the top part of your formula, 4,994.44. And the price is 999.53785. Let's say 5379. So the price, I think someone told the price, I don't know whether you got the right answer, 909.53785. Let's say 5379. So the price change is negative 0.4621. That is this minus, earlier price is 1000. Original price is same as the face value. So the price has changed by 0.4621. Now, do the same using the duration formula. Now you can, now this is using the normal formula, like previously do the same using the duration formula. Now duration formula, if you use the, earlier duration is 4.993. Change in interest rate is 0.01% means 0.0001. The face value, the original price is 1000 divided by original interest rate was 1.08. So it is 0.462315. So this is the price change if you use the normal formula for 1 basis point increase. This is the price change if you use the duration formula. That is, duration formula is minus D times delta R multiplied by the price divided by the 1 plus R. So the duration, we computed original duration 4.99271. The original price was 1000. Okay, so we just plug in those numbers. And for possible 1%, delta R is 1 basis point, 0.001. Now, what do you see? What do you observe? What do you see from now?
Two values are very closer.
Exactly. So what you see is the price change using the formula and price change using the duration formula is almost same. I mean 4621, 4623, very slight, small 0.002 difference. Okay. So what is the reason? Who is that, Anjali?
Yes, sir. Because
What is the reason?
it's only a slight change in the interest rate, only 0.01% change.
Exactly.
That's
So because for very small changes in interest rate, we can use the normal formula because for a small changes, we don't have a problem with convexity, right? Okay, so that is the reason. But for larger changes, we saw that in the previous questions, we cannot use the formula without doing the adjustment for the convexity. Otherwise, it will be different. Okay. Okay. Everybody got any questions? Please ask questions before we wind up. So anyone did for the 1 basis point drop? Now this is to the 1 basis point increase. Anyone did for the 1 basis point drop in yield?
yes, sir. 1000.46.
1000.46. Okay, let me go to that. Exactly. So you see, only thing is now the yield is 7.99. Earlier 7.1 basis point means 7.99. So use the discount factor and you end up with a new price of 1000.46. So the difference is 0.46, right? .46. So if you use you can compute the change using the same way like what we did here. You will see it is very much closer to 0.46243, right? Use the same formula. Okay. You don't have to work out because anyway it's the same increase or decrease, no? It should be the same. 462315. So you see 4623 and 46, because this change is same, because this is a decline, that should be increase, because for this we use negative, the interest rate, sorry, positive change, so that negative into positive negative. But here we use a negative 0.001 and this negative it should be positive. So we should get the same duration formula, that is 462315. Okay. Point 462315. Okay, so this is what we get, positive. So if you look at this point 4624 and 4623 almost same. So it works either way, right? So these are the answers for the question number, I think 5 or 6, for 1 basis point increase and 1 base. So that means it is very clear for smaller change in interest rate, we don't have to work it out in this manner. We can use the formula straight away, this formula. Okay.
So can you share this worksheet?
You can't see?
Can
Can't
you
you
share
see?
this worksheet, sir?
Which one? This one?
So, see, can you email the worksheet with us?
Okay, I'll see. But it's important is you have to work it out rather than, just, having, worksheet email, but you have to work it out yourself and see.
So, in
That's
the
the important.
exam, can we use the scientific calculator or it's a normal calculator by
No,
manually using?
normal way you have to do. In the exam, you
Okay.
have to do the normal way. You have to write the
Okay.
answer using, the like what we showed you.
Right.
Because anyway, you have to write it down, no? The
Yes.
methodology. You can't simply take the number out.
So it's the
I
manual
mean,
calculation and we have to show the
yeah, you
steps.
have to do it. I mean, you can use scientific calculator, but you have to manually put it out the way you do it, no? Because
Thank you,
then
sir.
no point, right? So I will mail probably the extracts, okay? Extracts, so you can look at the answers. So what is important, you all have to work it out because it is very important. That's why we did these questions, because otherwise you will not get practice. I mean, you have to manually work out now. Now, I have used this for easy presentation because otherwise it will take time if I have to work it out in the board. So, but you all have to work it out and see how it's actually happening. So, not only this one, work out some hypothetical, examples using, different ones, see whether what you get, and check with other friend who, couple of friends do the same thing and check what's the problem. If there is any question or any coupon, any bond, how do you do it? Right? Okay, I think time is up for the day. So we can leave the final part of the question, which is more important part of compute the convexity of this bond and derive the price of the bond using convexity adjusted duration. Now that's a very important. Now we can use the formula that is convexity adjusted formula, okay, and do the price of the bond for both increase and decrease, right? So that is the final part. So basically, if you can do any question like this, you should be able to work out durations, prices for any increases or decreases, using the formula as well as using the duration formula, duration model, not the duration formula, duration model for very small changes in interest rate or large interest rate changes using the convexity adjusted formula. The convexity part we will do in the next class. Of course, we don't have much time left today, almost 12:35, so that we can discuss it next time, the last part of the question. Any questions before we stop? So hopefully with the final part of this question, we will come to the end of duration during the first few hours of the next week class. So now basically that means you should be thorough with the repricing gap model, maturity gap, how do you compute, duration gap model, how you use different financial instruments to match your, hedging, exposure. So you must be very comfortable. Okay. Any more questions? Any questions? No? Okay. If you don't have any questions, we'll stop for the day. So we'll meet again next week, Sunday, same time. I think please go through the notes, and also if you have time, please work out question number 7 of the case study 1. So that anyway we are discussing next week. So try to do it yourself and see whether you can do it. Compute the convexity adjusted formula to use the price, which we did under the duration and convexity model. Remember, delta PO P equal minus D, delta RO1 plus R times half CX into delta R to the power 2, right? Okay. Okay then, thank you very much.